our understanding of the types of technical indicators. Now, traders who subscribe to technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. Now, technical indicators is only or are only a small part of the entire field of technical analysis. Because everything and anything we do on a chart, whether it's simply looking at a line chart or constructing a bar chart or adding a moving average or putting a trend line, all falls in the field of what's called technical analysis. Now, to an inexperienced eye, a financial chart may look like an unpredictable line with jumbles of colors and marks. But these traders are watching charts to pick up on the subtlest of indicators of where asset prices could be headed next. So there is a whole group of study under the field of what's called a technical indicator. Now, technical indicators are not price patterns. They're not support and resistance levels. They are indicators based on mathematical calculations, and in most cases using the open, the high, the low, and the close and volume in some way, shape, or form to give you some type of information. Now, the main similarity between technical analysis indicators is that they all use security prices. A small number of variables has produced hundreds and even thousands of technical indicators, and there's more and more of them popping up on the market every day. But the funny part is, the oldest ones, like stochastics and RSI, which have been around before online trading ever existed and before computers were ever available, still are the best today. Now, too many traders don't understand the differences in the types of technical analysis, and they lump RSI and Bollinger Bands together with trend lines, and then they lump it all together with triangles and head and shoulders, and they don't really understand where all of these different fields of study come into play. But technical indicators fall into two main categories. A technical indicator is a mathematical calculation that can be applied to an asset's past patterns like price, volume, and even other technical indicators. Technical indicators do not analyze any part of the fundamental business. They don't care about headlines. They don't care about earnings. They don't care about profit margins or revenue. Technical indicators are most extensively used by active traders in the market, as they are primarily designed for analyzing short-term price movements. Now, they fall into these two general categories: leading and lagging indicators. Now, I've been trading for 40 years, and I've been teaching for, actually, I think I just started 12 years now. And when I talk to traders, they'll tell me all about stochastics or MACD or this newfound indicator they're using. But then I say to them, well, is it a leading or lagging indicator? And they look at me like, duh. Okay. And I realize they don't know what they're doing, because what they're doing is they're trading what some buddy told them or some guru said, do this and do that and do this. In order to use any technical tools, you have to understand, not when somebody says, when this happens, and this happens, trade that. You need to understand all the basic information, the background. You understand, too many people are telling me, well, I use RSI, stochastics, and this other thing together, and it gives me a great entry point, or it gives me a great information. Yeah, you know why? The three of them that you're using are the same basic calculations and do exactly the same thing. And they don't know where they fit, what categories they belong to, how they can help you. So let's break down. The first part is leading and lagging indicators. Leading indicators are those who lead the price movement. They give a signal before a new trend or reversal occurs. So in other words, they help you see that a new trend is about to happen. Okay, where lagging indicators are those who follow price action. They give us a signal after the trend or the reversal happens. So a lagging indicator confirms that we've now moved to a downtrend. A leading indicator tells us we might be moving to a downtrend, or the uptrend is losing its momentum and most likely turn to a downtrend. Okay. But neither are better or worse than the other. You have to understand what category they fit into. Indicators from both categories fall into these 5 main types. We have trend indicators, we have momentum indicators, we have volatility and volume indicators. Now, the first big category, and the first most important, because if you follow the motto, the trend is your friend, are trend indicators. So even though we can draw a trend line on a chart, we always want to be aware if we are in a trend and what type of trend we're in. Okay. So we want something that's going to tell us that an asset is actually trending. So identifying trends over different time frames are useful because it helps weed out all the noise of daily volatility or short-term or hourly volatility. Trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular of these indicators is moving averages. Pure, simple moving average. A 10-period moving average, a 5-period, is a trend indicator. There's other ones such as MACD, moving average convergence divergence, or ADX, or parabolic SARs, and linear regressions. There's all kinds of them, but the most popular is simple moving averages. And MACD has been around forever and is one of the most respected indicators in the marketplace. Then we go on to volume. Volume is one of the most overlooked pieces of information any of it that we just forget about. And it's probably the most valuable piece of information you can get. Because volume, of course, is the measure of the total number of shares or contracts that are traded in a given period of time. Where volume really comes in handy is for confirmation. Regardless of how you're trading, if you see an asset's move through its support zone or bounce off its resistance level or broken out of a triangle, you'd like to know if the volume, if the traders around the globe are jumping in and supporting what you're seeing. And so it confirms anything. So when you get an entry signal or an exit signal, if volume isn't confirming it, then it's time to reconsider. So many traders use volume to confirm the conclusion of another type of indicator, such as a trend. Sometimes market conditions or the lack of liquidity alone can temporarily drive a stock or an asset's price higher or lower. However, these moves often occur on relatively low volume and can be short-lived. On the other hand, if an asset makes a big move on extremely high volume, that's a reliable signal that there's major buying and selling going on, and moves should be taken seriously. Volume indicators include everything from a straight volume chart to a money flow index to Chaikin money flow to on-balance volume to demand index to force index. Then we have another grouping of technical indicators, and one that I use depend on very much so, because I am a momentum trader. Momentum indicators are like speedometers for traders. They show how fast an asset is moving in any given direction. These indicators are typically displayed as oscillators, which fluctuate above and below a baseline to indicate how much positive buying or negative selling momentum an asset is experiencing. Now, being a momentum indicator, I look personally for a trade pattern. When I see a triangle develop and I see the trade moving into that apex of the triangle and I'm waiting for a breakout, whether it breaks up or breaks down, the minute it breaks out, I want to see what kind of momentum it has. Does the volume support it? And I'm ready to make my trade. So arguably the most popular of momentum indicators is RSI, or Relative Strength Index. Now, RSI falls into a group of oscillators, which are known as oscillators, and they're called bounded oscillators because these oscillators are mathematical calculations that will always come out between 0 and 100. And when they're placed on a chart, you have a buy zone and a sell zone. So for RSI, it's above 30 and below 70. Above 70 and below 30. But you could be using stochastics, which is 80-20. So what you're looking for is when the asset moves below 30, that's a signal that the asset is oversold. And the buyers could soon come back in and drive prices higher. So we have stochastics, CCI, or the commodity channel index. We have Williams %R. Then we have volatility indicators. And these are just groups of indicators. Volatility is the measure of how large an asset's movement in a given period tends to be. When an asset makes a large move in a short period of time, it is considered volatile. Volatility is a very important indicator for traders because volatility makes it easier to trade or profit due to price inefficiencies. When the market is volatile, it opens up opportunities to us, the online retail trader, because hedge funds and stuff don't trade volatility. And what they do is when the markets get volatile, they become sometimes inefficient where you can find excellent trading opportunities. Volatility is so important to traders that the Chicago Board of Options Exchange developed its VIX index, which is one of the most closely watched indexes in the world. We refer to it all the time as the fear index. In addition to the VIX, traders use volatility matrices, ATR, average true range, Bollinger Bands, and envelopes as trading indicators. Now, I gave you tonight a handout, which I said you can download. You can see it right there on your screen, the little Understanding Technical Indicators guide, which covers and goes over everything we're talking in class. Okay. And it gives them some general information, and it gives you these 5 types of indicators. Now, trend indicators measure the direction and strength of a trend using some form of price averaging to establish a baseline. Now, 3 of the most popular trend indicators are moving averages, and it's a lagging indicator. Then we have moving average convergence and divergence. It's also a lagging indicator. And we have parabolic stop and reverse, which is a leading indicator. You're going to find that most indicators are lagging indicators. Now, please don't let the terms leading and lagging make you feel positive and negative about one. Lots of people think leading is always a good thing and lagging is a bad thing. I wish we had other terminology, like maybe before and when, because leading is simply letting you know that a trend or a movement is ending, where lagging simply is telling you that it has ended. Because an overbought or oversold indicator can continue to be overbought and oversold for some time. So if you think of a leading indicator, let's talk about a rocket shooting into the sky. A rocket takes off and goes up into the sky. Okay. At some given point, if you knew all the weight of the rocket, how much gas, how much fuel, how much speed it was moving, you knew all the mathematical, scientific, and physics information, you could calculate when that asset, that rocket, would begin losing momentum. Not when it turned over and started coming back down to earth, just when it was losing the momentum to continue carrying it upward. Okay. Because based on that starting losing a momentum, you can predict it's about to come over and fall. Well, the leading is calculating the losing of the momentum. Okay. Where the lagging tells you that rocket has actually started to tip over and return to earth. So that's simply what the difference is where you are. So remember, leading gives trade signals when the trend is about to start. Lagging are those that follow the price action. Okay. Trying to predict price by using shorter periods in their calculations, thereby leading the price movement. The most popular leading indicators are stochastics, MACD, and RSI. Okay. Where lagging is they give signals after the trend or the reversal has started. Use them to determine a trend. The most common lagging indicator is moving averages. Now, these technical indicators measure the direction and strength of a trend by comparing price of an established baseline. Moving averages is simple. What does a moving average do? Moving average takes so many periods back, adds them all together at the close, and then divides them and comes up with the average price for that period. By combining two moving averages, a slower and a faster one, say a 9-day and a 30-day, you can get a moving average crossover, which will give you entry and exit signals, but they're simply letting you know whether an actual trend exists. If the moving average, because with the moving averages, it takes the noise out of the marketplace, because price bounces all over the place. When you see a moving average, you can see whether the trend actually exists. So moving averages are used to identify trends and reversals, as well as to set up support and resistance. Now, these indicators are designed to show traders and investors the trend or direction of the asset they are trading. The trend of an asset can either be downward, upward, or sideways. Then we come over to momentum indicators, which you'll keep hearing me talk about, stochastics and RSI, relative strength index. Now, these are both leading indicators, because what they do is they give you overbought and oversold indications. What that means is there's too much buying in the market, the price has been driven too high, or that rocket has reached all the way up and is starting to lose momentum. You don't know when it's going to tip over and come back down, but is losing that momentum. So there are momentum indicators that lead the price. So these technical indicators may identify the speed of a price movement by comparing current closing price to previous closes. Stochastics oscillator. Now, stochastics and RSI are two of the most well-known indicators in the marketplace. Everybody knows what they are, everybody understands it, and they are reliable. There's tons of literature in the internet to read about them and to understand them. But stochastics is used to predict price turning points by comparing the closing price to its price range. Stochastics is based on the fact that when a market is moving up, the price of each period usually closes towards the top of its price in that period. Okay. So by taking the close from each of those closing periods, the previous closing periods, and comparing them to the current price, it gives us an indication. It's a mathematical calculation. RSI measures recent trading strength, velocity, and the change in the trend, and the magnitude of the move, and gives us information also. The momentum is a measure of the speed at which the value of security is moving in a given period of time. So as you can see, momentum indicators are essentially composed of oscillating indicators that are used to determine overbought and oversold. Now, if you notice, volatility indicators all fall into lagging, because you have to see the volatility after the price moves. One of the most respected indicators in the marketplace is Bollinger Bands. It's been around for over 40 years, and it fits all time periods as well as all financial markets. And it's one of the few indicators that is actually dropped over price action. And it said that everything and anything you need to know about price and a trade is contained within the Bollinger Bands. And the bands will give you entry points, exit points, stop loss points, and tell you where the price, in which direction the price is moving, as well as giving you volatility. Then we come to volume. These technical indicators measure the rate of price movement regardless of direction. Volatility is so important in trading that you can find several indicators that measure it. The volatility is the relative rate at which a security moves up or down. And then, of course, I mentioned to you earlier, is volume indicators. Okay. Now, one of the best volume indicators is strictly volume. You just drop it on the bottom of your chart and you see the bars for the volume going up and down for each time frame that you're looking at. And you can see whether the more contracts are being exchanged or less contracts are being exchanged. And then we have other indicators that are calculating all of this volume for us. So these technical indicators measure the strength of the trend based on the volume of shares or contracts traded. The volume of trade is a very important component to trading. It is, for example, used to confirm or infirm a continuation or a change in a trend direction. Many indicators are also based on volume. For example, the money flow index is an oscillator tied to volume that measures the buying and selling pressure, use both price and volume. Now, overbought and oversold is very important. It only comes from technical indicators. Too many people think that overbought means to sell and oversold means to buy. Okay. When a security is overbought, the implication is that buying has pushed the price too far up and a reaction called a price pullback is expected. Okay. When an asset is oversold, the implication is selling is too much. But remember, it's like the rocket. Okay. The momentum is taking it up, and we say it can get 10 miles above the Earth's surface before it's going to turn back. But because of other types of conditions, it can move up to 10.5 miles. Okay, because we were just predicting it that it would start to flip down at 10 miles. But it can make it because an overbought market can continue being overbought for some time. It will eventually come back down, but it doesn't tell you that just because it's overbought, it can stay overbought or oversold for a while. So indicators serve three broad functions. They alert us, they confirm, and they predict. An indicator can act as an alert to study price action a little bit more closely. If momentum is waning, it may be a signal to watch for a break of support. Or if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. Indicators can be used to confirm other technical analysis tools. So in other words, if you're a pattern watcher like me and a triangle is developed on my charts, I need something, when I see the breakout, I need something to confirm if that breakout is just a tick or is it a good breakout, and then I can use my momentum indicators, my volume indicators to confirm my decision. Some traders and investors use indicators to predict the direction of future prices. Now, remember, indicators indicate. This may sound straightforward, but sometimes traders ignore the price action of a security and focus solely on indicators. Indicators filter price action with formulas. As such, they are derivatives and not direct reflections of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. What is the indicator saying about the price action of security? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signals should be taken in context with other technical analysis tools. Now, we use the word generate buy and sell signals. I don't use the word signals. I like to take it out and use alerts, because too many people see it's going to give me an entry point and an exit point. It's giving me a buy or sell. They fall under what some people call transaction signals. I'd like to call them alerts. They're hitting me in the back of the head saying, hey, dummy, look, there's a buy opportunity. Hey, dummy, there's a sell opportunity. And then I start applying my other technical analysis tools to make a decision. So if you don't think of them as buy and sell signals, but buy and sell alerts, they're alerting you to a potential. So an indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining peaks, it may be a false signal. As always in technical analysis, learning how to read indicators is more of an art than a science. Now, the same indicators may exhibit different behavioral patterns when applied to different assets. Indicators that work well for IBM may not work well for the euro-US dollar. Though careful study and analysis, expertise with the various indicators will develop over time. There's also times where you'll see a market, not just an asset. Today, why do stock traders concerned whether the S&P is up 200 points or NASDAQ is down 400 points? Because they're not just applying this to, they're applying the trading strategy they've developed to the particular type of market they're trading. So if we have a time where there's lots of fear in the market, people are uncertain, or they're waiting for a big thing to happen, or there's some geopolitical situation happening, okay, you may go in your little box of trading strategy and pick out the ones that work good under geopolitical stress and say, so today I'm going to be using MACD, RSI, and volume. Tomorrow, I may not be using any of these. I'm going to be biased because you have uptrending markets, downtrend, but you have overall types of markets. Some indicators are working well for this couple months may not work badly, but not give you good information, because sometimes you have sideways moving markets. Sometimes you have lots of, not just the asset, we're talking about the overall market. So through careful study analysis, expertise with various indicators will develop over time. As this expertise develops, certain nuances as well as favorite setups will become clear, because there are hundreds of indicators in use today, with new indicators being created every week. Now, I firmly believe in only using the well-established. I use RSI, stochastics, and MACD, and moving averages and volume. Otherwise, I'm doing everything else on my charts. And Bollinger Bands is fairly reliable, but I'm doing everything else with support and resistance, trend lines, and chart patterns. Now, given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. Even with the introduction of hundreds of new indicators, only a select few really offer a different perspective and are worthy of attention. Strangely enough, the indicators that usually merit the most attention are those that have been around the longest time and have withstood the test of time. Now, one of the most important reasons you should understand the types of indicators is because when choosing an indicator for the use in analysis, choose carefully and moderately. Attempts to cover more than 5 indicators are usually futile. It is best to focus on 2 or 3 indicators and learn their intricacies inside and out. Try to choose indicators that complement each other instead of those that move in unison and generate the same signals. For example, it would be redundant to use 2 indicators that are good for showing overbought and oversold levels, such as using stochastics and RSI. Both of these indicators measure momentum, and both have overbought and oversold levels. So let me pop up some live charts here for you. Okay. Now, we can see on this chart, there is so much stuff going on that it can be too much. But if you look at the indicators on the bottom, what do we see? RSI shows overbought levels, and stochastics RSI shows overbought levels. You know what? So it tells you the market's really overbought because you're using 2 indicators that tell you the same thing. So you're just wasting your time. Don't need the 2. They're going to tell you the same thing. Now, here we have a simple moving average with a crossover moving average, and it's going to give us sell setups and buy setups, but it also tells us the market is trending. We can see how price is trending right here on this blue line. We can even see the crossovers when, not when 2 moving averages, but when the moving average crosses the price level. So it helps us see whether the actual price is trending or not. But this is a healthy combination of indicators, but an overdone one, because they're also using bull flags, they're using they're using chart patterns. They're using Japanese candles. They're using support and resistance levels, moving averages. It's just too much, because all of that together, it's going to give you the same information that 3 of those pieces of information gave you. Here we have another one that we have MACD, RSI, stochastics, ADX, and DMI. And they're all basically telling us the same thing, because they're all similar to each other. Okay. So you could have gotten rid of the RSI, the ADX, the DMI, and simplified everything. We've got to get rid of all these EMAs and use a simple moving average. And we don't even need Bollinger Bands on here. And here we have volume. Now we've just cleaned up this chart. We have volume, MACD, and stochastics. Okay. We have a simple set of moving averages. We have an actual trend pattern. We actually have a very, very nice triangle here. We have our support and resistance levels on here. And we have a clean, nice trading system. It's not over complex. Okay. Which one would you rather have? All that stuff that we just erased off this chart didn't tell us any more than what we have by getting rid of it all. So understanding how to use these technical indicators, which ones fit in what categories, and why we'd want to use them, makes building a trading strategy relatively easy, and makes it less on you, because all you have to do is learn to use one indicator inside and out. You don't have to learn to use 10 indicators inside and out. And sometimes the simplest trading system is the best, because it's more about basically generating an alert in which direction, then using your money management, your risk money management skills, and order entry types to enter the proper order at the proper levels, and you've got it made. Because whether it gives you a buy signal or sell signal, you only have 2 ways you can trade the market. So on that note, I'm going to say goodnight to y'all. Use the handout I gave you. It breaks it all down for you. And go to www.alvexo.com and user education facilities, and they'll help you master all of this. But remember, understanding leading and lagging indicators is very important. Don't get yourself stuck in the prejudicial terms. So there's all kinds of benefits and drawbacks to leading and lagging indicators. So understanding where they are in price movement. So here we can see a leading indicator might have given you a prediction here and a lagging indicator here. Okay. Lagging indicators are usually more reliable because the change has already happened. Now, as their name implies, lagging indicators follow the price action, are commonly referred to as trend following indicators. Rarely, if ever, will these indicators lead the price of a security. Now, for technical indicators, there's a trade-off between sensitivity and consistency. In the real world, we want an indicator that is sensitive to price movements, gives early signals, and has few false signals. Okay? We all hope. Now, indicators do give you the ability to change their sensitivity levels or their mathematical calculations by changing the periods that they look at. But the minute we do that, you have to then reinterpret how to use it, because you can no longer apply the standardized decision-making capabilities, because you don't know by changing it how it's changing that indicator. So it may skew our risk-reward ratio by decreasing our false signals. It'll give us less false signals, but we don't know which will be false and which will be more. So I don't ever change the values of my indicators. I just change what my interpretation is. So there are numerous ones out there, but if you stick to the most popular indicators, the most well-known, like stochastics and RSI, MACD, okay, you'll start out all right. Because there's just tons of them in the marketplace. But oscillators are the most effective when used in conjunction with pattern analysis, support and resistance identification, trend identification, and other techno analysis tools. By being aware of the broader picture, oscillator signals can be put into context. It is important to identify the current trend, even to ascertain if the security is trending at all. Oscillator readings and signals can be different meanings in different circumstances. By using other technical techniques in conjunction with oscillator readings, the chance of success can be greatly enhanced. So on that note, I'm going to say thank you very much for joining us. I hope you enjoy the webinar, and I hope you use the handout we gave you. And again, go to www.elvexo.com and use their chart, set up a demo account, and use their education facilities. Have a good evening now, and thank you very much. Bye now.